Good morning, everybody.
Good morning, Yoshi.
Thank you. So let's kick off today's second day of global seminar. I trust that you had excellent night and we had excellent discussion yesterday. Yesterday's key delivery or message is IAIS with you are working hard to develop ICS, conference, and ICPs. And as we are totally clear, version 2 will happen 2019, and we work hard. ComFrame is ICS is a part of ComFrame, and ComFrame and ICS work together, and naturally ICP is a foundation. And as you have seen yesterday's morning, we have consulted ICPs very carefully and find a resolution and improve ICP2. So our standards is key components of our activities and moving well. ABA, separate issue, but activity-based approach, complementary to our entity-based approach, and that ABA will be established 2019. And we are working hard again to formulate and make a clear concept, and we will consult you in November. And as a dialogue group, we discuss very much about key issues, similar issues, but different angles. And some issues are related very much to today's topic. Today we cover implementation issue as a kickoff and market conduct issue, another important area of our activities, and also digital economy and fintech issues, and sustainable insurance and natural disaster prevention or insurance role, and so on. So today we are shifting gear towards more implementation and other areas. And the first panel is implementation. As we discussed yesterday, implementation without implementation of our standards, ICPs, ICS, ComFrame, there is no impact on our regulatory world and also our society. So implementation is the heart of the IAIS. And when IAIS was created, first activity that we did is cooperation, support, and work together. So implementation is a key issue. And we discussed this issue very intensively at the EXCO meeting La Jolla in January. And the EXCO members as hugely support or very much unanimously support the importance of implementation and particularly emerging market support and create a new group, small group of emerging market. And that group is naturally led the champion of implementation work, Jonathan Dixon. And Jonathan is the longest-serving executive committee member of the association, and he will be my successor from November. So this part is led by Jonathan, and he will enlighten us, and his group will enlighten us on all the activities of implementation of the association, and also, of course, emerging market support issue. Thank you.
Good morning, everyone. Thank you, Yoshi, for the introduction. I feel like I should be getting a long service award or something after that. Welcome, everyone, and very nice to see so many of you here this morning. After yesterday, you may be feeling like a break from global capital standards and systemic risk issues. So I'm very glad to be here this morning to talk about the very important topic of the link between insurance regulation and supervision and market development. This session will explore the open questions and issues around this link, or what is the nature of the link? Does the link even exist? between insurance regulation and supervision and how it interacts with market development. In particular, what role can it play in supporting increased access to insurance whilst at the same time still achieving our core objective as insurance supervisors of adequately protecting policyholders. So it's this balance, recognizing that whilst our core mission is the protection of policyholders, if we have a situation where insurance regulation and supervision creates a barrier to the development of the market and access to insurance, then really we have failed in our ultimate objective of protecting policyholders if we leave them exposed to the risks that they experience in daily life. So I'm very happy to have an esteemed panel here today. I'm going to introduce each of them to you. So first of all, closest to me is Hannah Grant. Hannah is head of the Secretariat at the Access to Insurance Initiative, a key partner of the IAIS. Hannah is well placed to talk on this topic, being at the Access to Insurance Initiative and working with supervisors every day on this question of how to build access and apply regulation and supervision in a proportionate way. But she has also been on the market development side, having previously worked at Insurance Europe in Brussels, where she also helped set up the Secretariat for the Global Federation of Insurance Associations. So she's very familiar with the market issues as well. Next to Hannah, we have Julian Adams. Julian is Group Regulatory and Government Relations Director at Prudential PLC, where he's been since 2015. But Julian will also be very familiar to many supervisors in the room, having previously been Executive Director of Insurance Supervision at the Bank of England. And I guess Julian is also very well placed to talk about either side of this interaction between supervision and the market development. Jumping on to from Julian, we have Stephen Cartwright. Stephen is Commercial Director at MicroEnsure, where he's been since January 2013, specifically to help MicroEnsure transition from being a not-for-profit entity into a commercially sustainable business dedicated to creating, distributing, and operating products that help uninsured people in emerging markets to mitigate the risks that they face daily. At the end, we have Juan Carlos Crisanto. Juan Carlos is Deputy Chairman of the Financial Stability Institute, the FSI, within the Bank for International Settlement, the BIS. I'll be seeing you soon. And Juan Carlos is Deputy Chairman there, managing the day-to-day activities of the FSI, another key partner of the IAIS in our supervisory capacity building initiatives. Juan Carlos has also spent time at the Basel Committee on Banking Supervision, so very close to banking supervision issues. He's been at the BIS since 2001, so you will have seen many developments in the debates on supervision. And before that, he was head of the regulation department at the Peruvian Banking, Insurance and Pension Funds Authority. And then last but not least, in the center, my colleague Li Tang, who is my vice chair in the IAIS Implementation Committee. and a very good one at that, and also Director of Research in the International Department at the China Insurance Regulatory Commission. So a very good mix of perspectives. We are going to try and make sure the panel this morning, we only have an hour, so therefore we're going to try and keep the formalities of presentations and so on to the minimum and make sure we have a bit more of an informal conversation and interaction amongst the panelists on the key topics, and hopefully try and make sure we have time for a couple of questions from the audience at the end. But first of all, just to give us a flavor of the issues and a very quick introduction, I'm going to hand over to Hannah to set the scene for us. Thank you very much.
Good morning, everyone, and thank you, Jonathan, for the introductions. I'm delighted to have this opportunity to help set the scene for what I'm sure will be a very lively discussion on the supervisor's role in market development. In setting the scene, I'm going to be drawing on the Access to Insurance Initiative, or the 8YI's, experience working on the ground with insurance supervisors in Africa, Latin America, and Asia, and really the variety of different ways that we've observed insurance supervisors trying to help their domestic insurance market to develop and also just generally increase access to insurance. So as sort of Jonathan mentioned, and as is stated in ICP1, I mean, the responsibility of an insurance supervisor is primarily to maintain fair, safe, and stable insurance markets. And therefore, I mean, traditionally what we've seen is insurance supervisors focusing on protecting consumers and ensuring financial stability through both prudential supervision and setting market conduct rules. However, increasingly, what certainly the 8Y has been observing is supervisors also focusing on market development. And this is particularly the case in emerging and developing countries, where I feel supervisors are very much aware of the need to strike what I call a healthy balance between regulation protecting policyholders, but then also at the same time enhancing access to insurance. And I think with insurance penetration rates in Africa are at probably about 2.8%, in Asia 5.7%, but that's very much skewed by China and India, so it would actually be probably more similar to Africa otherwise, and in Latin America at 3.2%. I think the case for insurance supervisors to take on a more development role might seem a bit more, or might seem more obvious. However, I would also argue, and would welcome actually the panel's thoughts on this later, that I think the need for insurance supervisors to take on a market development role shouldn't just be seen as a sort of a developing market or an emerging country issue. Although insurance penetration rates are certainly lower, much lower in emerging and developing countries, the markets are growing. And that in contrast, in more developed countries, they might currently have higher insurance penetration rates, but I think in recent years, many of these countries have actually been seeing a decline overall in the insurance penetration rates. So the current state, so while sort of consumer protection and financial stability are well recognized as being a core to an insurance supervisor's mandate, I think the precise role that an insurance supervisor should play in supporting market developments and how this fits along its other supervisory objectives is still sort of a bit of a matter for debate, hence the subject of today's panel. But what 8Y has been observing is that increasingly insurance supervisors not only recognize it as important in their markets to take on a more development role, but it's actually explicitly included in their mandates. So just to name a few countries, sort of India, Philippines, South Africa, Brazil, Kenya, Malaysia, and Ghana, they actually have included in their sort of supervisory mandate, actually written in the sort of the legislation, this is part of their role as a supervisor. So why might, aside from having it actually in their mandates, but why might insurance supervisors want to get involved? I think I'd pick out three sort of core sort of reasons that 8Y has been seeing that they might want to get involved. I think the first I've already sort of touched on briefly. It's the maturity of the markets. In emerging and developing economies, insurance markets are typically sort of less deep and less efficient, you could say, than in developed countries, and therefore a more activationist, more sort of interventionist, approach is needed to try and accelerate growth and help these countries catch up. A more relaxed, should we say, laissez-faire approach may not be sufficient for really getting market growth. Second sort of reason that insurance supervisors might want to get involved are political considerations. I think supervisors are often actually pushed by their governments to take a more proactive approach in developing their insurance markets. Governments, I think, increasingly are recognizing that enhanced access to insurance can help to reduce poverty and improve social and economic development, and therefore they're telling their insurance supervisors that they need to be more proactive in this area. This might result in insurance being included in a financial inclusion strategy, or sometimes it's a specific topical focus, so following a big catastrophe in a country, be it a big flood, be it a big hurricane, insurance supervisors are told to make sure that if another event happens, more people in the country have insurance to help protect them against the event. The third reason that we often see insurance supervisors wanting to get involved is just really to cope with the market developments that are already happening. So there's a lot of innovations happening in insurance markets now, and it's challenging sort of traditional sort of regulatory assumptions and traditional regulatory approaches. And supervisors need to be able to keep up with these market innovations and ensure they have a good understanding of these new products that are being developed, as well as the right tools to supervise them. And therefore, it's important for them to be proactive and get there sort of ahead of the curve, and therefore get involved at an earlier stage actually in the market development. So those are sort of the three reasons I'm going to give as the why insurance supervisors might want to get involved. And I'm now going to sort of share some examples really off the how of what HYI has been seeing in terms of how supervisors have gone about supporting market development. And I'd say here there's a whole sort of range of different ways that supervisors have done it, and you can view it actually as a bit as a continuum, with some supervisors just playing a very passive, or you could say facilitative role, whereas others have been a lot more hands-on. So at the less sort of interventionist end of the scale, supervisors might just collect data about who the underserved are, maybe proactively identifying and drawing industry attention to a specific in-need group. And this will then, it saves industry the costs of doing this initial research and also draws their attention to where a market opportunity might be. At the other end of the spectrum, we see supervisors even actually mandating the take-up of certain products or provision of insurance to certain segments of the market. And I give the example here actually of India. And in India, it's a legal requirement for insurers to ensure a minimum of 20% of policies that they're writing cover the rural and the social sectors. And then in the middle somewhere, I would put sort of engagement with the industry. And this could be in form of sort of working groups and collaboration, or also just moral suasion. So what exactly works in a country will differ for each country. Every country is very different. But no matter where on the continuum a specific supervisor is, I think one thing is quite clear, that insurance supervisors can play a very important role in motivating the industry to serve the underserved and helping the market develop. I'm going to sort of talk a bit more now about the specific tools that we've seen insurance supervisors using, just briefly. And here I'm sort of picking out three different tools. The first being just developing what we call proportionate regulation. The second being actually adjusting the supervisory tools and techniques. And the third are sort of a group of other complementary measures. So starting with regulation, I mean, both the lack of and too much regulation can be a barrier to market development. But if the right balance can be struck, it's a real enabler. I would also argue here that the right amount of regulation should correspond to the maturity of the markets. So in a more mature market, it can deal with more complex regulation, whereas a nascent developing market might benefit, at least in the first stages, from more openness. Or in IAIS speak, and I maybe leave it to the panel to say whether this is a fair analogy, but regulation must be proportionate to the nature, scale, and complexity of the risks inherent in individual insurance businesses. It must also strike a balance between motivating the industry, but at the same time, protecting the consumer. So, for example, insurance supervisors can create a more enabling environment in their markets by clearly creating a definition for that particular underserved target group they would like more insurance to be made available to. So, for instance, a microinsurance definition. And then they can adjust standard regulatory requirements for this target group. So this might be allowing non-traditional distribution channels to serve this target group. It could be allowing electronic transactions. They can also create special licenses for certain types of providers, this can also help bring sort of informal insurers into the licensed markets. There's also the adjusting of sort of rules and requirements on things like disclosures, premium collections, alternative forms of documentation. And I say sometimes these should be lighter requirements, but other times actually more onerous requirements sort of might be required because particularly in developing markets, the consumers are more vulnerable. So there is a real balance to be struck here between sort of enabling the companies to come in and provide the products and making it attractive, but also protecting the consumers and developing trust in the markets. But aside from putting in place proportionate regulation, supervisors can and should also adjust their supervisory tools and techniques. So this can include different product oversight processes, different product registrations, and setting up different performance monitoring things as well, so they can actually monitor sort of the claims times, renewals, so they get a better understanding of the different market segments, and I think the quality of the insurance that's being provided. So I'm going to I've talked about sort of regulation and supervision, and I'm going to now switch sort of to the industry perspective, sort of just briefly. This is actually not based on my, my time with Insurance Europe, but this is actually based on a survey that the A2II recently commissioned actually of the MicroEnsure Centre. And this was a survey among 101 insurers from actually 46 different countries, but across Africa, Asia, and Latin America. And we asked the industry what they felt were the most important factors when deciding whether to enter into a market and also to stay in that market. And with respect to regulation, the top 5 things that they mentioned to us was the most important was actually having workable disclosure content requirements. The second one was allowing market-sensitive language. The third one was being able to use fully electronic policies. The fourth one was the availability of specific regulations, in this case for microinsurance, but we also interpreted that just to be regulatory certainty. And the fifth one was just allowing the use of any means of payment. So I think these examples sort of show that by developing proportionate regulation and adjusting certain tools, supervisors can take important steps to help the markets grow. However, the same market actually also asks what market factors have the most significant impact on insurers' decision to enter into a market. And actually it was noticeable here that overall a higher ranking was actually given to the market factors than the regulatory factors. And here the most important things were mentioned as the availability of different distribution channels, just the availability of market information, internal technical expertise, potential profit in the market, and the availability of market education programs. So this to me shows that regulation is certainly important, but a regulatory framework alone, with appropriate supervisory tools to back it up, is not sufficient to actually grow an inclusive insurance market. And actually what is needed is also complementary efforts in the areas of things like financial education and industry training. So, so what sort of complementary, and this is my sort of last set of examples that A2I has observed supervisors doing. So yeah, what sort of complementary measures have we seen in markets? We've seen supervisors getting involved in financial consumer education efforts in their countries, sometimes driving efforts, sometimes working as part of a sort of multi-stakeholder effort. We've also seen them just coordinating and discussing with other authorities in their countries. Sometimes this is the physical authorities. Sometimes it's just getting additional funds for their own work, which I think is very important. Other times it's maybe lobbying, almost you could say, on behalf of the insurance industry to get tax exemptions or reductions. It's maybe working with other authorities in the country where there's things like mobile insurance being done, where it cuts across sort of regulatory perimeters to make sure the environment is clear for those doing business there. So it could be communications as such, let's say with the telecommunications authority. And the same might go for the cooperatives of authority in some developing countries. And then another sort of set of ways we've seen insurance supervisors getting involved is engaging in market development initiatives. So here we've seen in a few countries insurance supervisors actually doing diagnostic studies about the market and the regulations, which they then publish and share with the industry afterwards, providing them with useful information if they want to try and break into that market, and organising stakeholder workshops. So to conclude, from what A2I has seen on the ground, I think we do believe that insurance supervisors can have a pivotal role in supporting, facilitating, or even driving insurance market developments in their jurisdiction. However, it is important that these initiatives are based on a sort of thorough assessment of the jurisdiction-specific challenges, that they do involve industry dialogue, and they factor in coordination with other authorities. And it's also very important to remain flexible. Things are continually changing in the marketplace, and so supervisors need to allow for a sort of a test and learn approach. So these are my initial thoughts, which I look forward to hearing the panel discuss later on. Thank you.
Thank you very much, Hannah. I'm going to try speak from the chair. Everyone can hear me okay? Good. So thanks very much for that summary. I'm going to turn to, let's say, our market participants on the panel, Julian and Stephen, and ask for their perspectives on this question. So I guess, first of all, we've heard huge potential for market development, that a number of supervisory authorities around the world are engaged in this problem. Hannah has made the argument that supervision can and does have an important role to play, but I'd like to hear your perspectives on these issues. First of all, maybe to step back and remind ourselves, why is insurance market development important? So what do you see as the links between insurance market development and broader economic growth and development? What does it mean for improving lives in the countries in which you operate? And then secondly, to the question, what are your views on the role of the supervisor in supporting this market development? What has been your experience in entering new markets? So perhaps I can ask Julian to start and then hand over to Stephen.
Okay. Thanks very much, Jonathan. I think I'd approach this really in 2 or 3 ways. The answer to your question about what's the goal, as it were, that we're trying to achieve. The first is we're trying to take risk out of people's lives, and a lot of what Hannah was talking about was, as it were, the front-end consumer experience. And so in terms of the public good, what the insurance delivers, there we are, taking risk out of lives, whether it's the risk of breadwinners falling, not being employed, and so ability to carry on education of children, whether it's funeral insurance, so both those examples are within an African context, or whether it's in more developing or developed markets, whether it's income protection or whether it's kind of mortality protection, i.e. the money that's paid when one dies. So I think you can look at the goal of insurance as trying to take risk out of individuals' lives and corporate lives on the non-life side. But there's also another side which I think we underplay both as an industry and as insurance supervisors, and that's the positive externalities that can arise economically when you do that. It's a much more, in exchange for medium to long-term commitments. Insurance companies, are, as well as pension funds, are incentivized to hold long-term assets, duration match the liabilities of their assets. And this presents a tremendous opportunity in emerging markets to finance longer-term commitments, and whether that's in the infrastructure side, whether it's through financing long-term government debt markets. And the Prudential company I work with, we helped the Vietnamese government with a 10-year bond, a 20-year bond, and now a 30-year bond. Now that's a tremendous opportunity of extending the life of government debt, but then also giving benchmarks for the ultimate pricing of corporate debt. So you have insurance taking risk out of individuals' lives. You have the more productive channeling of savings. And in terms of what one would do is, what's the role of supervisors? I think Hannah made a very important point, which is around grounding insurance supervisors' core principles, their core objectives, referencing within, all supervisors will have some variant of safety and soundness and treating customers fairly. It'll be couched in different language, but most of them have those objectives. But I think equally important is to balance that with the desire to encourage competition, to facilitate competition, and a number of supervisors have that equally as a primary objective. You can extend it to say some supervisors would even regard it as part of their role as to have regard for the competitiveness of their market. But I think certainly supervisors having regard for competition as an objective, low barriers to entry, which essentially driving through market participation, increased depth of market participation, a better deal for consumers of products. And that's, I think, a very important grounding for supervisors, because I think otherwise the other expression that Hannah used was, and it's the usual, all supervisors to have this tucked away somewhere in their objectives, to act proportionately. I mean, the charge of industry is always, well, goodness, how are you acting proportionally? It's much easier to evidence that you act proportionately if you have regard, proportionate with regard to what? And I think the balancing of promoting safety, promoting soundness, fairness, but also facilitating competition is an important, a difficult task for supervisors, but an important one for them to grasp.
Thanks, Julian. Stephen?
Thank you. It's pretty similar to Julian. I'm coming from the perspective of a business that provides microinsurance. So these are sums insured of kind of a few $100s, based on life, or kind of tens of dollars if it's a health hospital cash product. So this is kind of really at the base of the pyramid that our business is actually looking at, and we've had some pretty good success. And I think one of the reasons for that is echoing what Julian said. We kind of view our clients and their lives like a game of snakes and ladders. So a lot of them kind of have jobs and businesses, and they kind of move up the economic scale, and the risks that they face are pretty severe and pretty frequent. And when these life events happen, it can immediately put them into immediate poverty, and the consequences of that can be very dramatic. So our vision and our aim is actually to provide that safety net at that level. It isn't going to kind of significantly improve their situation, but it's that safety net to prevent them going into immediate poverty and the impact that has. So economically, I think it's massive. And there was a recent study, I think, this week in India, just at a higher level, that I think the India penetration from what Hannah was saying was kind of a little bit higher than some of the other Asian economies, but it's at 3.4%, and that's still pretty low. And this study kind of mentioned that if that penetration was up another 1%, it would have the equivalent to an increase in India's GDP of 2%, because of the kind of the reduction in the losses and the additional investment that could actually happen as a result of that. So from an economic standpoint, insurance in any economy is very important. Secondly, just moving on to the role of the supervisor, where we have the interactions, we're predominantly going into new markets, setting up new markets, producing what we believe are kind of pretty not necessarily innovative products, but innovative channels or distribution channels to the market. And it's critical for us that the role of the supervisor does not prevent growth. We don't necessarily see the role of the supervisor in kind of creating the growth, but we do see some examples in some geographies where they do prevent growth. So there's kind of one example, I won't name the country, but it's in Asia, where there are significant criteria for microinsurance. And we have to work very carefully to produce products and take those to market that can be successful within the boundaries of what we're allowed to do. So one product that we took to market around about 18 months ago, in 6 months following the launch of that product, we had 35 million people with access to life insurance. So it can be done. And in Africa, there's another example where commercially we're not doing as well as we could be doing and taking products to market because the regulator is not approving products. So we want to see growth. There is growth. There's huge demand out there, and the role of the supervisor is critical to allow the market to grow and flourish.
Great. Well, I think that leads straight into my next question to Lee. As a regulatory authority from an emerging market where these issues of market development are key, and where we've heard the huge benefits that can come with this development, but as Stephen has said, this challenge of creating the right enabling environment. So how does the regulator make sure they don't get in the way of the market development, but at the same time still achieving their objectives of protection of policyholders? And your perspectives.
Thank you. I guess this topic of the balance between market development and effective supervision is a common theme for many countries, especially in developing countries. Well, some other countries like China also have a 5-year plan for the growth, development of the insurance industry. And some of them even clearly have market development in their mandate or in the insurance law, as Hannah said. So it's a very important theme for the emerging market supervisors. I think the first thing or the first problem that we must solve is whether there is a conflict between these two objectives. So, well, for China, we think, no, they're not conflicting objectives because if the market is developed, the consumers will benefit from more insurance products. So this will meet their needs of protection. And if the supervision is effective, the insurance companies stay healthy and they provide quality products to the consumers can be better protected. So both of these goals are for the interest of the people. So when we figure that out, we will not feel internal conflict as to what we should do. Okay, so the next step might be to assess the situation and to see what should specifically be done in order to achieve both objectives. For example, if you think agricultural insurance is very important to provide protection for farmers and rural population, then the supervisor should look at the market to find out the obstacles to the growth of the agricultural insurance. And that's practically what we did. We talked to the market participants to discover why they are not so willing to provide agricultural products to farmers. And we talked with the farmers to ask them why they do not want to buy such products. And then we determined that there's a role for the supervisor to play in this. That is to find government support for the premium subsidies so as to make this kind of product both profitable for the insurance companies and also affordable to the farmers. And also, as a supervisor, CIRC is in a good position because it is a ministerial level authority. So it can talk to the premier. Also, it can have negotiation power with the other relevant departments of the government, such as the Ministry of Finance. So we believe that this is the role that CIRC should play. Therefore, we designed a program that is guided by the government and operated by the market participants with government subsidies. So this actually worked quite well because from the year 2007 to 2016, that's 10 years, the premium for agricultural insurance has increased by 7 times. Now it is the number 2 in the world after the United States and number 1 in Asia. So we can see that it's quite successful. But at the same time, besides promoting this agricultural insurance, we need also to enhance the supervision there because in order to make this program a sustainable one, we need to eliminate the risks in there. For example, the moral hazard. So that's why we strengthened our supervision, and we started an inspection on all the agricultural programs run by the insurance companies with a focus on anti-fraud. Yeah, so that the government will continue subsidizing this program, yeah, so that this agricultural insurance can be really sustainable. So this is an example. Maybe it can show that how should we understand these two objectives and what specifically should we as a supervisor do in this. I think the most important thing is to find a good role for the supervisor to play.
Thank you. And Juan Carlos, lastly for yourself, you're an organization that deals with supervisors on a daily basis from across the broad membership of the IAIS. What are the issues that you're seeing, the questions that supervisors are asking themselves, and what you're seeing in terms of possible useful avenues to explore in this regard?
Thank you, Jonathan, and thanks for the invitation. Good morning, everyone. We're just to allow members of the audience to be familiar with the FSI, the institution where I work, just very briefly to say that we are the part of the BIS that main mandate is to assist financial sector supervisors in strengthening their financial systems. In the insurance domain, we work very closely with the IAIS, mainly about an annual program of meeting and seminars, also with FSI Connect, which is an e-learning tool for financial sector supervisors. The first one program, which is an online course on fundamentals of banking supervision, and we're just launching a policy implementation work also in the insurance area. So with this context in mind, what are the key issues that are being raised in the context of our work? I would say the first one, Jonathan, is there is a lot of interest when we talk with supervisors about learning or understanding a bit more what are the changes in business models as a result of the low interest rate environment, and also as a result of the regulatory environment changes. So that's one issue that is actually multidimensional, but has relation to what we discussed because of at least two implications. One deals with what is the impact in terms of profitability, and what are the investment options driving this potential impact on profitability, what is the reallocation of portfolios. The other one relates very much with the issue of cross-border implications, and also if these changes in business strategies will have an impact on penetration in new markets. For instance, on operations of cross-border entities, subs including. So that's one dimension that we hear a lot. The second one, Jonathan, is there is a heightened interest in understanding the risks associated with innovation, with market developments. So here talking about very much risk management, what are the best practices in risk management techniques, and they range from issues related to technology. I mean, what are the technological issues, operational risk associated with this increased role of technology, all the way to issues of what to deal with situations in which there is little data. So how to understand, because the rationale behind this interest is that supervisors feel that they, in order to embrace the market developments, they need to be comfortable with the risks involved in those market developments. And that is driving this interest. The third one is of course, what we see is this heightened interest as well in dealing or understanding the technological and increasing role of technology and innovation. This is very much to understand what is the difference between hype and disruption. What is the impact of this in terms of the premiums, in terms of the insurance business, in terms of the customer protection, legal issues associated with that. There is also a lot of interest in our work in relation to understanding what would be, for instance, and someone mentioned the issue of competition, what would be the scenario in which big technological players such as, for instance, Amazon or Google would enter this sphere and start competing with insurance firms. And finally, a key topic that we encounter when we deal with supervisors is to understand and discuss what are the opportunities and challenges connected with the deepening of insurance markets in relation to the increasing role of technology.
Thank you very much. Given the time, I'm going to turn now to in a sense, the second part of the question that's posed in the theme for today, which is what role do international standards, or can they play in terms of getting this balance right between market development and protection, and how are they helping to inform supervision and getting that mix right? And Lee, I'm going to turn to you first for your perspectives on that. Perhaps you might have a slightly biased one, being a part of the leadership of the IAIS on international standards, but over to you.
Well, thank you. My answer is certainly the international standards are very important for the supervisors to achieve a balance between effective supervision and market development. Well, China is a very good example. Whenever we want to develop some new policies, the first thing we would do is to look at ICP. And then we look at the supervisory practices in other jurisdictions to see what they are doing, how they are applying the ICP in this area. Take FSAP, for example. We had the first FSAP in 2011 and the second one last year. So from 2011 to 2016, the market has developed significantly. The premium income actually have more than doubled to the current 3.1 trillion RMB. And the net asset has more than tripled. And also the penetration has grown from 3% to 4.1%. So why are there such a big development? So what happened in those 5 years? Well, the key findings of our first FSAP, well, there are many findings, but the key finding is that, well, China is having a very strong, the supervisor has a very strong influence on the business development and strategy of the insurance companies. That the assessors think that maybe this influence is too strong. Maybe the control is too tight or too direct. And on the other hand, China's solvency regulation system at that time is static, is more static and not sufficiently risk-based. So taking away from that key finding, what we did in the past 5 years, it's something we call loosening the front end and tightening the back end. So what we did is to implement a pricing interest rate reform for life insurance products, lifting the ceiling for the pricing interest rate of life insurance products so that the insurance companies will have a bigger say in the pricing. And also we broadened investment channels. So that is the loosening the front end part. And, but in order to control the risks, we developed the China risk-oriented solvency system, which is called CROS. It's a risk-based one to better reflect the risks of insurance companies. So it's a much more developed solvency system. I don't want to take too much time, but I think basically based on the findings of this FSAP, on the gap between the Chinese practices and the international standards, we find what we should do, and we did what is needed, and that achieved a good result, which is the growth we currently have. So we think international standards are really helpful.
Okay. So there we have a very clear example of where international standards have had a direct impact on the supervisory approach, and it would seem on market development. But I want to turn to Julian and Stephen and get their experience. Particularly, what do you see as the importance of adherence to international standards when you're thinking about entering new markets, and what influence does it have on those decisions? Maybe Julian first and then Stephen.
Look, I think it all depends upon the standard of the market you're entering. Can I, before I directly answer that, can I just sort of take a step back? I'm pretty cautious about this. There's a huge role, of course, for international standards, but equally, having been a standard setter, there's a gravitational pull from developed market, from the developed markets to developing markets. And I think you need to be cautious about that, because I think being so, and it goes back to the first point I was making about how you balance objectives. You can be so risk conscious, Juan Carlos was saying, that you can actually stop the development of markets. I think a really good example, I think if you look at financial inclusion within Kenya, it's been fantastically successful because it's the central bank allowed the development of telephone banking, and almost telephone currency. Other markets have been much more cautious. I'm sure they've been much more, risk aware, but actually financial inclusion rates haven't developed as much. So I think, it's constantly balancing this. What's the greater risk? Is it that nothing happens? And you have the memorable expression the British Chancellor, former Chancellor of the Exchequer used, the stability of the graveyard, or do you allow some dynamism to develop here? So do international standards per se, do they drive investment decisions on our part? There has to be a basic level of stability, but equally I think we can point to markets that we've entered, that we've helped develop those markets and actually helped, along with other companies, we're not but bringing in international companies, actually our standards are often higher than local standards, and I think that's also a very positive dynamic. Where I'm cautious is where, on things like anti-money laundering, some of the financial crime legislation, very well motivated, but if you try and impose too rigidly developed market standards on developing markets, it will not work. And that's why I'm a bit more cautious than perhaps the supervisors or the financial stability people here, because I think there has to be a role for competition, for dynamism, growing in markets, and not just being conscious of the risk of those things happening.
And Stephen?
Yeah, so I think for us, as we kind of expand and grow into various markets in Africa and Asia, when we enter those markets, we want to be seen by the regulator, by the supervisor. So we introduce ourselves. We try to make the regulatory authorities aware of what we're doing and our approach to the market. This is actually pretty helpful for us because it makes everything very transparent. Now, the challenge for us is that what we're trying to accomplish doesn't necessarily fit within the standards that are actually set. So it's working with the supervisors and the regulators to find the best options available to us, and then getting our products into the markets and actually getting to scale quickly. I think some of the challenges that we've seen, and I'll go into a little bit of detail just to give you some examples, but some of the challenges that we've actually seen have been where the government regulators across industry bodies do not get on as well as they possibly should do. Now, a lot of our distribution channels are within the telecom sector, the mobile network operators, and there are general challenges between the communications regulator and the insurance regulator and maybe the banking regulator as well. And where we are trying in some markets very successfully taking product to market through these new channels where we're not allowed to use airtime as a currency, for example, for those mobile phone subscribers to purchase insurance. That actually makes it very, very difficult to actually get kind of access to the market. Now, I think traditionally, the percentage of premium in traditional insurance is actually pretty high of someone's income. When we're talking about mobile phone subscribers, we're actually talking, maybe $1 or $2 a month that they're actually spending on their airtime, and the actual premium is maybe less than 5%. So there are things like that that constrain the market development, and there are lots of areas, and I've got a number of examples down here that I can share, or you can speak to me about. But what we want to do when we take products into new markets is a frictionless or a friction-free experience for the consumer, and any of the regulations and that detract from that or cause friction is actually going to impede market development. So a few things that we've kind of got around working with the supervisors, things like wet signatures. So actually having the ability to enroll digitally, either by mobile phones or other kind of mediums, but predominantly the mobile phones because they're so pervasive in emerging markets, and actually not having to kind of provide certificates of insurance, a kind of a physical document, but actually having that electronically stored, or even not at all. The amount of KYC data that you actually need on enrolment, we've worked with various regulators to actually have virtually none. So all we collect is a mobile phone number. That's it. It makes it really, really simple for the consumer in those emerging markets to have access to insurance, to understand the product, because the products are very, very simple. We try to work with the regulators and the supervisors to minimize exclusions. So we had a product in Pakistan where it was a life product with no age limit, no exclusions whatsoever. So these simple products can grow the market. It gives a very, very good experience to those at the base of the pyramid, to the emerging consumer, who then in years to come will actually have a positive experience of insurance. So I think I've rambled on a bit, but it's kind of really trying to work to reduce the friction as you take products to market.
Thanks very much. I'm looking at our facilitator. Given that we start a bit late, maybe we have time for one or two quick questions from the audience. Bernie?
Hi, thank you for your presentations. I'm Bernie Birnbaum with the Center for Economic Justice. So in the U.S. and other developed countries, sort of microinsurance products, analogies are credit insurance or credit-related insurance products, credit life, credit disability. And they've come under intense criticism across the globe because instead of being asset preservation tools, they're asset stripping tools because the payouts are so low, loss ratios in the teens or low 20s. So my question is, on the products that you're offering in the emerging economies, if there was a loss ratio of 25%, would that meet the consumer protection needs? Is there some loss ratio for which you would say this is not a product that benefits consumers but ultimately harms consumers? And if there is such a loss ratio, what is that percentage?
Thank you. I'm going to take, I think, the two questions and then ask panelists to respond. So please go ahead.
My question's a bit different. I just wanted to get the perspective. We've heard in the press a lot recently, focusing on China. Obviously, from the corruption probe with Cirque, the chairman's been dismissed. And with the chairman of Angbang in China, we've heard that he's been detained by Chinese authorities. I wanted to get the perspective whether that is putting off firms wanting to sell business in China, and is there a need for greater transparency with those issues?
Okay, so let's take the first question. and get any, and Stephen, perhaps that's an issue for you in particular.
Yeah, I'll just answer that from our experience. So where we have facilitated credit life products on loans through MFIs, both in Africa and in Asia, we actually see the loss ratios up around about the 60-70% mark. So we actually believe that those are products operating pretty well within the boundaries of acceptability. So where we actually see lower loss ratios are in the products where we take to market through the more digital channels, and where we've used insurance as a customer behavior tool. So if a mobile phone subscriber, for example, spends a little bit more on their airtime, the mobile network operator will actually pay for their premiums on their behalf. So where we see those products in the market, the loss ratios are a lot lower, around about 20 to 30%, and that's predominantly because people may just be not fully aware of the product that they have. They've changed behavior, but they may not be fully aware. So it's an educational process that we actually work through with our distribution partners to really raise that awareness. And the other element is that sometimes on some of these really kind of low premium products, the sum insured is actually pretty low, and some of the people will say, I don't want to claim for that. But that's mainly on the free products, so where the premium is actually paid on their behalf. Where we see the premiums being paid by the low income, more and more, the first six months, probably the loss ratios are lower than we would expect, but we actually see that ramping up as the product gains a little more maturity and knowledge in the market, and the educational kind of processes and marketing is actually starting to work, and then it kind of ramps up north of 50%.
Julian?
I have a stab at the second question. I'm not going to comment on domestic, what's happening in China. I can talk about the attractiveness of China as a market. And I think, where do I start? In my statements, taking risk out of people's lives. There are a lot of lives to take out in China. It's a dynamic market, and one that we're certainly committed to.
I think that the recent developments within the Chinese insurance industry and the financial industry as a whole is a very healthy step to ensure the financial stability of the country. And I think we don't see any foreign insurers want to pull out from China. No, the attractiveness is still there, and basically this is perceived as a positive thing for a healthier market.
Thank you. So I'm going to try wrap up now and ask our panelists to give a headline closing statement. I think we've heard a lot about the fact that on the one hand there could be supervisors who are doing things out of the best intentions to try and support market development, which may have unintended consequences about creating barriers. On the other hand, Stephen, you've made reference to conversations you've had with supervisors around relaxations of regulations that might make some supervisors here in the room slightly nervous. So the issue is really how do we move forward to find that happy medium where you achieve those supervisory objectives but are a force for supporting market development. I'll ask panelists to give some thoughts on that, and particularly FSI and Hannah from A2II, maybe mention a little bit about what you're doing to support that journey. Maybe we can start with Juan Carlos.
So let me just give you 3 thoughts on that. Number one is about helping supervisors implement international standards in the way that takes into account market-specific characteristics. So here we're talking about 3 concrete things. Talking about be mindful of the environment, the consumer needs, the legal framework, the culture. I'm also thinking clearly, supporting what Hannah said, proportionality. It's critically important here. The second point is very much about capacity building and education and open dialogue. I have to stress this quite a lot, because I truly believe that if supervisors are aware, understand the latest developments, understand the market developments, they and understand the risks involved in that, they are not going to be an obstacle for this to be engraved or to move forward in their market. So for me, that is critical and is important. Open dialogue, as my colleagues were saying, not only with supervisors, but also with the industry, is with other authorities within the broader financial sector industry, with the non-relevant, non-financial sector stakeholders, telecoms, etc. So this is crucial for us. And final, for all of us, we need to have more coordination in terms of the work for helping to make a healthy but increase access to insurance. This is more coordination, more cooperation, more discussion at the international level.
Maybe Hannah next.
Yeah, my sort of key takeaway actually from this session is I feel everyone's really agreed along the panel that insurance supervisors have an important role to play in market development. But we've been hearing very slightly different ideas of how supervisors should go about doing it, which I take from, the context is very important. So from the more developed countryside, I was hearing that it's really controlling and stimulating competition is sort of where the supervisor is needed. Whereas in the more developing markets, it's just simply enabling access in the first place. And also encouraging the industry to come in and participate. So I did feel that you really need to look at the context before the supervisor can really decide what tools are most appropriate in the environment. And then what is A2II doing? I feel the whole of A2II's work is aimed at trying to help create this sort of enabling regulatory environment. But I want to just pick out two examples of sort of recent projects just to mention. One is actually a study we published earlier this week, which is proportionality in practice case studies. One is on the topic of distribution, the other is on the topic of disclosure. And these are really case studies from 3 to 4 different markets of how the supervisor in that country has implemented the international standards in a proportionate way. So it's enabling supervisors to see in different contexts how they can possibly implement the ICPs in a proportionate way. And I'd encourage you to have a look at our website if you'd be interested to see a copy. The other thing is actually a very new project and a very different sort of project for A2I to be involved in. And we've also, this is a very recent project, we've just launched what we call an innovation lab. And we are in the process of selecting 4 different countries, which led by the supervisor will be putting together multi-stakeholder teams. And over a 12-month period, these teams, through a series of facilitated workshops, will have discussions in the country, originally just to say, well, what are the barriers to market growth? We have low insurance penetration rates, but why are they low? And that's sort of the first step. And then there'll be international dialogues where the different countries will share what they've been discovering. And then the next step is to start thinking about the innovations and what could be different in that market to really help the market develop. And again, there'll be an international lab where the different countries will share what they think their innovations are. And at the end, we hope to see some real changes in those markets. So we're right at the beginning of that, and subscribe to the A2I newsletter and we'll keep you informed of how that process is going.
Great. And then Stephen, Lee and Julian, 1 minute.
I'll probably be less than that, which is just dialogue. Let's keep that dialogue flowing. Be open, be flexible, support and promote.
Excellent. Lee?
Well, for me, the key takeaway is that the international standards are really important for the emerging markets. Not only the standards themselves, but the supporting materials as how to apply those standards in different contexts. They are really important. So the emerging markets, of course, they should learn from the developed economies as how to better supervise. But they also need to have peer-to-peer exchange with other emerging markets. So I find what IAIS has been doing and what A2II has been doing, it's very meaningful in that way.
you largely gave the summary I'd give, but I absolutely endorse the comments that Lee made about the work of the IAIS. I think could really be a lot more about implementation and best practice sharing among supervisors who are at an equivalent stage of the journey, as it were, rather than necessarily standard setting, and just be cautious about setting standards that are perhaps inappropriate for the maturity of the market that they're at.
Thanks, Julian. That's very much music to my ears. I can say I hope this panel has helped bring some perspective to the seminar as well, in that certainly the work on the post-global financial crisis work around improving global financial stability and so on is critical, and that we complete that work, given the massive impact that global financial instability can have on the lives of poor households in emerging and developing countries. Unfortunately, they feel the brunt of that. But hopefully this panel has put into perspective that there is an as big, if not bigger, challenge around the other side of the story, which is actually just creating and building the insurance market, because of the massive impact it can have on improving lives and economic growth. And in sum up, I just want to reflect on what the IAIS is doing, and I think a number of the panelists mentioned it. It's this idea of we have standards, but we also need to make sure they're applied properly. And how do we do that? It's the work we do on the supporting material, the application papers, the proportionality and practice case studies, but increasingly it's the work we're doing with supervisors on the ground to encourage peer-to-peer exchange, capacity building, and actually regional implementation. And just to assure the panelists, this will be an increasing focus of the IAIS going forward, because of the huge impact that I believe supervisors can have in market development and improving lives across our broad membership. So thank you very much, everyone, and appreciate the time.
Excellent panel, thank you very much. This panel reminded us what's the role of insurance, not only stability, but also protection of people, and also support growth of the economy. And this theme is not only emerging market, but now developed countries are facing how insurance regulation or industry itself support the economic growth.